Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. Okay, before we start this video, another thing just to briefly go over is that if you look in the description of the video, underneath the video, there is in part of that description of the video, you'll find a section that is for links and descriptions to other videos on different topics about the SPX Daily Key Levels indicator, which is as you see here. So if you would like to see further details on any particular topics that are covered here, some of these we may just briefly go over in this particular video today, and we'll reference this section in the video, and you can return to the video description to look up that topic and look at a more detailed video on that particular topic. Thank you. Hello, in today's video we'll be taking a look at the Wednesday, October 29, 2025 trading session for the SPX CBOE index. And we'll be utilizing the Day Trading GPS SPX Daily Key Levels indicator for trading 0DTE SPX options, and specifically we'll be using the newest version of the indicator, which was just released a few weeks ago, the V2.0 version. Okay, so today is an FOMC interest rate decision day. So these days that are FOMC interest rate decision days, you have to be fairly cautious on these types of days and trade them a little bit differently than you would a normal trading session. Some people just prefer to skip them altogether. Because they can involve more risk than the typical session, because we can get heightened volatility, but with that heightened volatility, especially after the interest rate decision at 2 p.m. Eastern time, you can get some pretty wild moves, and so there are lots of opportunities that come with that volatility, but there's also lots of caution with it. So some traders prefer to skip FOMC interest rate decision days. Other traders look forward to it because it usually has some increased volatility with the 2 p.m. interest rate decision and then the 2:30 p.m. Press conference that Jerome Powell holds as well. So in any event, some of you may be already familiar with how this indicator works. But for those that may be new to this channel who have not seen any of these videos before on this indicator, I will run through how the indicator works before we get into today's session. So this indicator is for the TradingView platform only. So you do need to have an account with TradingView in order to use this indicator. This indicator works on two different SPX symbols depending on what instrument of SPX that you're trading. So the symbol that you see right now that the chart is on is the official CBOE SPX index. So on TradingView, that is the SPX symbol, and then you would look under the SPX symbols to find the CBOE exchange for SPX. And that would be the symbol that we have it on currently. That symbol is what you would have it on if you are trading SPX index options, such as is the main strategy with this indicator and the strategy that we'll be going over today. The indicator also works on a second SPX symbol, which we'll pause the video and go to that now. And that symbol is the SPX 500 symbol on the 8-cap exchange. So on TradingView, you would look up SPX 500 as far as typing that in the symbol search, and then you would look for that symbol under the 8 cap exchange. This is a Forex CFD symbol, and you would use this indicator on this symbol if you're not trading SPX index options and are instead trading through a Forex broker. So with Forex brokers, typically with Forex, you're either trading currency pairs such as USD JPY or Euro USD or many of the other major currency pairs, or you're trading various indexes such as the S&P 500 through what's known as a Forex CFD. And then other people also use Forex to trade metals such as gold and also crude oil through Forex CFDs as well. Another reason that you would have it on the SPX 500 8 cap chart is if you're involved in a trading challenge with one of the trading challenge companies that are out there. They're primarily Forex based companies that offer you the opportunity to take a trading challenge and make a certain amount of profit in a certain amount of days, or sometimes it's unlimited amount of days, but some of them have limits on the amount of trading days in which you need to make that profit without hitting your loss limits, either your daily or total loss limits. And if you qualify by passing the challenge, then you may be offered a funded account with them for a specific amount, in which now you can trade utilizing your funded account with them, where they provide the risk capital up to a certain limit. So if you're using one of these trading challenge companies such as FTMO, Apex, 5%ers, or there's many dozens of other ones out there, and that is the way that you're trading SPX instead of index options, then you can also utilize this indicator for that purpose. The other reason why you would want to have it on this SPX 500 symbol, even if you are trading CBOE SPX index options, is because while you have it on this symbol, you could open up a second chart on this symbol and you will be able to get the levels for the CBOE index 30 minutes early at 9 a.m. Eastern New York time, which is 30 minutes before the CBOE SPX index opens. The CBOE SPX index does not open until 9:30 a.m. Eastern New York time. It does not trade in the pre-market or overnight. And for that reason, excuse me, even though the indicator already knows what the levels are going to be for the current day session at 9 a.m. Eastern, it cannot plot them on the SPX CBOE chart until the first tick at 9:30 market open, because of the way that TradingView PineScript coding works, that if the market is closed for the particular symbol that you have it on, even if your indicator already knows and has already done the calculations for the levels, PineScript does not allow you to plot them on the chart until the first tick when it opens. So when you have it on the SPX CBOE chart, you will get the levels at the first tick at the 9:30 a.m. New York time open. However, you can get a 30-minute jump and know the levels 30 minutes early by opening up a second chart with this SPX 500 8 cap symbol, and then you will see the CBOE SPX levels in this second table right here. So this table here is for the SPX 500 8 cap levels, and the levels shown on the chart are for the symbol that the chart is on, SPX 500 8 cap. But you can see, because this symbol trades in the pre-market and overnight, you can actually display the levels for CBOE SPX via a second table. So for those that would like to do a little planning and get the levels early at 9 a.m., which can be very useful to sort of get things sort of lined up ahead of time, this can be a very useful feature that allows you to get a 30-minute jump on the session for CBOE SPX. All right, now we'll go back to the main chart. Okay, so we're back on the CBOE SPX chart. We're on a 2-minute chart here. This indicator works on chart time frames of 1 minute up to 30 minutes. So if you try to put it on something above 30 minutes, such as an hourly chart, while on the SPX CBOE symbol, then you will get a disclaimer notice on your chart telling you to put the chart time frame back somewhere between 1 minute and 30 minutes. So, 30 minutes is really just maximum time frame for intraday trading, and that is what this indicator is made for, intraday day trading. So this is not a swing trading indicator. This is a day trading indicator where either way, whether you're using it on the 4X to the SPX 500 8 cap, or you're using it on the SPX CBOE chart for trading index options, you are going to be opening and closing any position all in the same session. So it is for day trading only. It is not for swing trading. You're not holding any positions overnight, and you're not holding any positions day to day. You are simply opening and closing positions all within the same session. Now you see we have it on the 2-minute chart, so the recommended time frames for most strategies are going to be between 1 minute and 5 minutes, with the recommended chart time frame for the particular strategy that we show in all of our videos, and which is the same one we're showing today, which is simply buying calls on bullish entry signals and buying puts on bearish entry signals. We have found that the 2-minute chart works best out of the 1 to 5 minute range. If you prefer to use a different time frame when using it, some people prefer a different time frame because they've grown accustomed to it. That's fine. It's just that you'll see in all of our videos that we use with this particular SPX indicator a 2-minute chart time frame for this particular strategy of trading SPX index options. Now there are people that use this indicator for other types of option strategies that involve selling options or option combinations, where they may be doing iron condors or butterflies or many other types of combination option trades. So that's not what our primary strategy is. Ours is simply buying puts on bearish entry signals and buying calls on bullish entry signals. We're not doing spreads, we're not doing combination trades, we're not doing iron condors, butterflies, etc. However, there are people that do use it for that purpose, and the point I'm trying to get at is that if you're using it for other types of strategies, such as the iron condors or butterflies or some of the other combination option strategy trades, then you may find that using the indicator on a longer chart time frame, such as 10-minute, 15-minute, or 30-minute, may work better for you for those particular strategies. But for this particular strategy, 1 minute to 5 minute, we have found the 2-minute to be the most efficient for this particular strategy. Okay, so the way this indicator works is that while it's on this CBOE SPX symbol, as I mentioned before, at the first tick at the 9:30 a.m. Eastern New York Open, you will get the levels here on your screen as you see, along with these two tables. That is the default look of the indicator. We do have a video that, if you look in the description of the video, as was outlined in the preview that started before this video, there are links in the description to many different videos on several different topics regarding this indicator, one of which is one video that will go over the full features and all of the inputs and customization that you can do with this particular indicator. So as stated in the preview of the video, there are many topics covered through different videos about this indicator, which you'll find in the description underneath this video for this video. So if you want to see full detailed videos on any of those topics, then simply go to those links and you'll be able to see a more detailed video on those topics. We may touch briefly on some of those topics during this video, but very briefly, but just go back if you have questions about any particular thing which may touch on, then you can certainly look and go to view those other videos for a more detailed video on that topic. Okay, so we'll go through the levels right now. The most important level that the indicator gives you at the 9:30 open is going to be this level here, the SPX Bull Bear KPL, which stands for key price level. And for today's session, after analyzing market dynamics, volatility, recent price action, as well as overnight and pre-market action in the ESC mini futures, as well as market dynamics in recent days on the SPX and volatility and some other proprietary aspects that the indicator goes through, analyzing the bull bear key price level for today's session that it is coming up with is 69.1066. So each day at 9:30 you'll get freshly updated levels after the indicator completes its analysis. However, if you want to see it early, as I said, you can have it on the other SPX 508 cap and get the levels at 9 a.m. So 9 a.m. is the earliest that the indicator at 9 a.m. Eastern New York, and when you can see the levels for the CBOE SPX. However, at 9:30, then you will have them on the CBOE SPX chart, as we mentioned earlier. So what this actually represents is the all-important bull bear pivot for this particular session. So as far as the bias, it is bearish below this level and bullish above this level. Now, that doesn't mean that you can't take bullish or bearish trades off of the other levels. This is just the main bull bear pivot for this particular session. The main R levels above, R1 through R6, are your take profit levels for trades that are for bullish trades that where you have a bullish entry signal that's derived and generated from the bull bear key price level. The R levels above and the midpoint levels after a certain point has been reached or exceeded are your take profit levels for bullish trades initiated from the bull bear key price level. Conversely, the main levels below and some of the midpoint levels below, but all of the main levels below, and then the midpoint levels beyond a certain point that's exceeded would be your take profit levels for bearish trades that are initiated from bearish entry signals off the bull bear key price level. However, you can take bullish or bearish trades off of the other main levels. So what do I mean by main levels? Well, the bull bear key price level is the main level. The R levels are main levels, and the S levels are main levels. The midpoint levels are not main levels. The midpoint levels have other uses, which I will get into in a second, and then all the QL levels are not main levels. They have other uses. So the main levels, as far as taking bullish or bearish trades from, are the bull bear key price level, and then your R1 through R6 levels, and then your S1 through S6 levels. Now, when you first open up this indicator, when you're first using it, we do have a default display. So we do have a video on how to take that default display and how to customize it to where it's the best look for the open, and part of that is zeroing in at the open between the R2 level and the S2 level, or say R3 to S3, or somewhere in that range. You don't want to have all 6 levels above and all 6 levels below, because if you put all that on the screen, it's going to look too busy. So you want to zoom in on, say, R3 to S3 or R2 to S3, or somewhere in that range. And then that way you can see things in a more granular view as we have now. One of the reasons is because you have this all-important range here, which involves this midpoint level above the bull bear KPL, the first midpoint level below the bull bear KPL, and then this QL above and QL below. So on the default startup display, which you can change and customize to a different look if you prefer, the levels that are shown in that default display on startup are going to be the bull bear KPL, the QL above the bull bear KPL, the QL below the bull bear KPL, the first midpoint above, which is the midpoint of the BBKPL in R1, the first midpoint below, which is the midpoint of the BBKPL level in S1, then the QL above, QL below, and then the R1 through R6 levels and the S1 through S6 levels. These other midpoints that you see are optional to turn on. You would generally turn them on in the direction of how the trades are going. Usually, if you'd like to have a nice default look to start off with, you could just start off with the mid R1, R2, and then the mid S1, S2 also being turned on as far as on the start of a session. So on a start of a session, the most prevailing level that you're either going to be taking a bullish or bearish trade on, if you're inclined to take either a trade on the opening 9:30 a.m. candle, or sometime in the first 5 minutes to say 15 minutes of the session, is going to be the bull bear key price level in 95% or more of the sessions. So that's why it's important to have your range on your screen maximize so you can see this on a more granular level, and that's why these levels here are turned on by default surrounding the bull bear KPL, because these are used as stop losses on either a bullish or bearish trade. So for example, on a bullish trade off of the bull bear KPL, the QL below the BBKPL is a tight stop loss that you would use on a bullish trade initiated from the bull bear KPL, and the midpoint below it would be your standard stop loss on a bullish trade. Conversely, the QL above, it would be your tight stop loss if you choose to use a tight one on a bearish trade that's derived from the bull bear KPL. And the first midpoint above would be your standard stop loss on a bearish trade derived from the bull bear KPL. Now, in the user control panel, you can turn on the QL above and QL below any main level. So you have tight stop losses that you can use for either bullish or bearish trades on the other levels as well. You just have to turn them on in the user control panel. And then also the same thing with the midpoints. As I explained, just the midpoint above and the midpoint below the bull bear KPL are turned on by default. The other ones you can turn on, so you could turn on the midpoint above and below R2 and any of the other levels by simply going to the user control panel and turning them on. And if you prefer to have more of them turned on to start with, then you can just make that your new default look. So let me get into the other levels. One last point I want to make here is that Uh, as I mentioned, during the first, either the 9:30 opening candle or the first, say, 5 to 15 minutes of the session, 95% or more of the time, your trades are going to be derived from the bull bear key price level. However, as the session progresses, then other main levels, either main R1 through R6 or main S1 through S6, come into play, and you can take bullish or bearish trades off of those levels as well. So we do have a video on that aspect of taking trades off of the other main R and S levels, and that is also in the description of the video, and that also goes into the two different types of trades: the standard trade entry, whether it's bullish or bearish, and then also the more conservative trade entry, which takes additional confirmations and explains the differences between both of those as well. So if you want to see more on that topic of taking trades off of the other levels, then you can watch that video. There also is another video which is about using the historical levels feature of this indicator, and that also can be very useful when going back and looking at past sessions of the key levels that occurred each day, and that way you can sort of get an idea from looking at those past sessions using the historical BBKPL and historical R and S levels feature of the indicator to get an idea of what other levels, at least in recent sessions, however many you want to look at, the last 2 or 3 sessions, the last 5 sessions, the last 10 sessions, the last 30 sessions, what have you, to get an idea of normally which other levels are providing the best risk reward bullish or bearish opportunities on an average daily session. So that video is also in the description. So if you'd like to see more on that topic, you can watch that particular video, and it also explains how that feature works. Okay, so you also see these levels here that are on this particular table, and they're also lined up here. The PMH is the SPX pre-market high. The PML is the SPX pre-market low. The YDH level is the previous day's RTH session high. The YDL level is the previous day's RTH session low. And the YDC is the previous day's RTH session close. Now these are also important key levels, and they can have a couple of different purposes. One of which is for breakouts, either to the upside or downside, as far as gauging continuing momentum. So as you can see here, the PMH level is below this midpoint level and below the R1 level. So if we're going to get a breakout to the upside, then we're going to have to see sustained candle closes staying above the PMH and not closing back below it. Conversely, on the PML, if we're going to be seeing a sell-off of any magnitude, as you can see, this PML is just below the midpoint, below the BBKPL, and it's above S1. So if we're going to get any significant sell-off, it's going to start with candle closes and sustained candle closes below the PML level. The YDC level, yesterday's daily RTH session close, also a very important level. Oftentimes you may see reversals at that level. However, if you don't see a reversal, then that means that they typically are going to create a sweep of stop losses from other people that are holding long positions under there, and that may just be a very brief one before they return back up to and above the YDC level. However, the point is that that is also a very important level to watch as well, as is the YDL, yesterday's RTH session low. So these different levels, the YDH RTA session high. As you can see here, this YDH for today's session is 69.1130. That's just above and in high confluence with today's BBKPL. And as we saw in today's session, the BBKPL was tested many times once it got under it. For a second time, and it was not able to break above that or the YDH level. So when you see these levels that happen to be in confluence with another main level, they can have increased significance. Now these tables here are optional to display. You can turn them off if you wish. You can also change the size of them. You can also change the location of them. They're both individually controlled, so you could turn one off, leave one on. You could turn both off. You could move one to one area, one to a different area. They're both independently controlled. All these line labels are also independently controlled as groups. So all of these levels here are controlled as one group. All the midpoint levels are controlled as one group. All of the main levels are controlled as one group. And all the QL levels are controlled as one group. What I mean by that is that you can change the line label text size of the group. You can also change the offset to make it more to the left or right for that particular group. As you can see here, I have the offset set the same for each one of these groups. And also the PMH, PML offset, I have the same as the YDH, YDC, and YDL offset. That's why they all appear in a row. However, they are individually controlled by groups. So if you like a different look than this and different line label sizes, then you can customize it to your own liking. Okay, so let's get right into the session. As you can see here, this is the 9:30 a.m. opening candle for this session. So as you can see, this was yesterday's daily close, so we have another gap up. It did try to push above. It opened below, tried to push above the bull bear KPL on this 2-minute chart, and sold off with this wick here. Tried to go back up, but it still closed below the bull bear KPL. So if you're inclined to trade the 9:30 a.m. opening candle, this is your bearish entry signal. Now we do have a video in the description, which is a video on are there any 9:30 a.m. candles that even if they close above or below the bull bear KPL that you would want to specifically avoid the opening candle, 9:30 a.m. opening candle trade, even if it would normally technically qualifies for a bullish or bearish trade. So we do have a video on that particular topic, and there are sessions that happen a few times a year. Sometimes it's a couple of times a year. Sometimes it might be 8 or 10 times a year or once a month, just depending on what sort of market that we happen to be in. But out of the 250 sessions, it may happen up to, say, 10 times a year where you may have a situation where you would want to avoid. So that particular video goes into that aspect of 9:30 a.m. opening candle trades that you would want to avoid and what to look out for. And in that particular video, there's also a link to a more detailed document which also goes into that as far as in written form as well to accompany that as additional details that go with that particular video. But generally speaking, outside of the aberrations and exceptions that you would see by watching that video, what you're looking for if you're going to take the 9:30 a.m. opening candle trade is that you are looking for where the candle closes. Now, as I said, we have found the 2-minute chart to be most effective out of the 1-minute to 5-minute range for this particular strategy. So this 2-minute candle is closing below, even though it tried to push above, it is closing below. So that is the first and foremost, the most important aspect if you're going to take the 9:30 a.m. opening candle trade is where does the candle close? So you don't want to be entering the trade intra-candle because anything can happen. So you want to wait till the candle closes, or if it looks like it is significantly far away, instead of having a chance of going either way, you could wait till 5 or 10 seconds before it closes to start doing your order. But generally speaking, if it's very close, then you do want to wait for the close, because if this candle had closed above the BBKPL level, then we'd be looking at a bullish entry signal if we were inclined to take the 9:30 a.m. opening trade. There's no rule or obligation that says that you have to take the 9:30 a.m. candle opening trade. There are many traders that use this indicator, and they simply prefer to wait for the session to play out somewhat, to whatever degree they feel most comfortable with. Some traders feel more comfortable letting the first 10 or 15 minutes play out. Some traders feel more comfortable waiting till about 10 a.m., which would be the first 30 minutes. Some traders want to wait for the full 1 hour opening range to be over with, which would be the 9:30 to 10:30. So every trader is different. We trade the 9:30 opening candle, except where there may be an exception or due to that aberration I talked about earlier that we discussed in the other video. But that doesn't mean that you have to. So other traders prefer to have wait, and some traders prefer simply to trade off of other levels. They study the historical sessions, and they prefer to take bullish or bearish trades off of other levels, which normally is going to occur later in the session. Okay, so on this trade, like I said, the main thing you're looking for on the opening candle trade is where is it closing? Is it closing below the BBKPL, so it's a bearish entry signal, or is it closing above, which would be a bullish entry signal? In this case, we have a bearish entry signal. Next, we have to decide what SPX 0DTE option are we going to trade. Now, you can use 1DTE options on this indicator as well. We would not recommend that you use anything more than 1DTE because of the fact that you are going to be opening and closing any of these trades all in the same day session. So if you're going to use something that's more than one day or more, such as something that expires next week or something like that, you're paying for time value, which is going to reduce your profitability because you're paying for a lot of time value that is pretty much irrelevant for opening and closing trades, which may be just minutes apart from between opening and closing them. Sometimes it may be a few hours. But in any event, you're going to end the day flat. You're not going to carry over any trades. You're not holding anything overnight or day to day. You are closing out any trade you've opened before the end of the session. Now, we do have a video on 0DTE versus 1DTE, in which we did a comparison video of a session earlier this week, and that video is also found in the description of this video. So if you'd like to see more on that topic, that happened to be a very good session to go over that topic, and we show you the pros and cons of each. However, in today's session, we're not going to do that. We're simply going to look at 0DTE options today. Okay, so how do we decide what strikes that we're going to use now that we have a bearish entry signal? So with this indicator, for any given trade off of any main level, whether it's a bullish or bearish trade, there's always 3 different strikes that you can use. The way you determine those strikes depends on what level you're trading from and whether it is a bullish or bearish trade. So for example, this trade, we're trading off of the bull-bear KPL. It's a bearish trade, and the bull-bear KPL is 69.1066. So the standard option play is off of the bull-bear KPL to use the at-the-money strike that's closest to the BBKPL price. So in this case, that would be 69.10 strike. And since we're doing a bearish play off the bearish signal, then it would be a 69.10 put. If it was instead a bullish play, then it would be a 69.10 call. In this case, though, it is a bearish play, so it's a 69.10 put. That would be considered the standard play. There are also 2 out-of-the-money strikes that you can consider. How you figure out which ones those are going to be is you simply look at the level you're taking the trade from, in this case the bull-bear KPL. What is the direction that you are trading on the entry, bullish or bearish? Well, in this case it's bearish, so we look below for the out-of-the-money strikes on a bearish play. The first out-of-the-money strike that you can consider is the first on a bearish play is you look for the first midpoint below the level that you're taking the bearish play from. Since the bearish play happens to be from this level, we look to the first midpoint level below, and that is mid BBKPL S1 690205, and you have the closest strike to that is the 6900 SPX strike. SPX trades in 5-point increments for those that are not familiar with how SPX options work. So 6900, 6905, 6910, 6915, 6895, 6890, etc. So the closest strike to this is 6900. So the 6900 put would be your first out of the money option that you could consider on a bearish trade, bearish entry signal from the BBKPL level. The final option that you could do is one level away. One level this away, remember this is the half level away, the midpoint level, in the direction that we're trading. Bearish, this is the level we're trading. One full level is the S1, 6893.43. The closest strike to that is the 68.95. So those are your 3 choices. If, just as a quick example, and we have a video on this topic as well that you can go into more detail, but just to give you a quick example here, if instead we were taking the trade off the S1 level and we were taking a bearish trade, and we had a bearish entry signal off of the S1 instead of the one up here, then our at the money would be the closest to this level. So our at the money standard play would be the 68.95 put. Our first out of the money would be the closest strike to the first midpoint below on the bearish play, and that would be the 68.85 put, which is the closest strike to this midpoint. And then the furthest out of the money we could consider would be the closest strike to one level below, 68.7620, so that would be the 68.75 put. Like I said, we do have a video on this topic which goes into figuring out on all the rest of the levels for bullish and bearish trades, but it is pretty simple once you get to using it a few times. And one thing just to mention real quick is that we do recommend that, and this applies not just to this indicator, but for any indicator that you are new to using. Whether you're paying for an indicator or you found a free indicator, whenever you're using a new indicator to base trades on, to base trading decisions on, it's generally a good idea to spend 25 to 30 sessions practicing with that indicator and refining your process, getting used to using the indicator, getting used to placing entries with the indicator, stop losses, managing your trades, taking your exits, managing your stop losses after initial entries if there are adjustment periods. Basically getting used to using the indicator, seeing a wide variety of market session types and different scenarios that you would see over, say, a 4 to 6 week period, which would entail 20, 25, 30 or so sessions at a minimum. And then by the end of that time, you should have the using the indicator should become second nature by that point, and then you've gone through having wins, having losses, and a whole bunch of different scenarios where after that amount of time using it for 25 or 30 sessions, you should have your process down pat. You should be very familiar with the whole process and the speed at which you can react to the daily process of placing trades, analyzing what to do after you place them, etc. And you should do that on a demo account before you transition to using that new indicator that you were unfamiliar with. You have to get familiar with it by using it in a demo account. That's our recommendation. Some people just do what they want to do. However, it's usually prudent, and it really doesn't matter whether it's this indicator. You could buy one from a different company. You could find free ones. It doesn't even matter whether you paid for it or it's free. If you're going to be putting real money at risk, you should do the prudent thing and practice with that new indicator for a significant period of time. I would define a significant period of time of being at least 25 to 30 trading sessions. Other people may define it as something different, but that is the most prudent thing to do, because then you have the best chance of long-term success in utilizing it before, because you developed a process before, and then when you're satisfied with that process and satisfied that now you know this, it's a very second-hand nature to you now, then you can, at that time, if you feel that everything is positive and you're satisfied with everything, then transition to using it over in a live account. Okay, so we have the 3 strikes. Now we're going to look at the price. The price, well, first we'll look at the stop losses. Okay, regardless of which strike you use, whether it's the at the money or the out of money, you use the same stop losses. The stop losses are based on the level that you're trading, whether it's a bullish or bearish trade, and whether it's a tight or regular stop loss. So this is the level we're trading. It's a bearish trade. On a bearish trade, the QL level above on a bearish trade, the QL level above the level you're trading is the tight stop loss. And the first midpoint level above on a bearish trade, the first midpoint level above the main level, is your standard stop loss. The standard stop loss is the recommended stop loss to use. However, some people prefer the tight stop loss. They know that with the tight stop loss also comes, it's more prone to getting stopped out. That's the con side of it. The pro side of it is you technically would have less money at risk because it's a tighter stop loss. However, the con side of it is that it's more prone to getting stopped out. The standard stop loss is less prone to getting stopped out. There are many sessions where the tight stop loss will get stopped out and the standard one will not. However, in this case today, both were stopped out. Now we use the standard stop loss. We don't show what the loss would have been on the trade with the tight stop loss. But if you want to take a look, just go look at the data boxes as what it would have been when it hit the tight stop loss, then it will be less than the stop loss per option that we're showing up there at the 9:56 a.m. candle when it did hit the standard stop loss and we had a stop out. So regardless of which strike you're using, because you're taking a bearish trade off of this main level, these are the initial stop losses. Now, if the trade starts going in your favor and you're doing a regular trade, not a scalp, so there's two different types of trades you could do, a scalp or a regular trade. A regular trade has a certain target that once it's met or exceeded, then you have the option, if you don't want to close out all your trades, all your options, to adjust your stop loss to break even or break even plus a profit buffer. When you do an adjustment, then the stop loss at that point is changed from a level to a price. Break even being the price that you paid for the option, or you're doing break even plus a profit buffer, which we'll see here in a minute how that is typically calculated. So to begin with, your initial stop loss is based on a level. If the trade starts going in your favor on a regular trade, once you've met the minimum required amount of movement in your favor, if you don't want to close out 100% of your contract and you want to do a stop loss adjustment, then at that time you're simply changing it to break even by price, or your break even plus a profit buffer. All right. So the buy price on the at the money 69.10 0DTE put, $17.90. The first out of the money strike is the 6900 put option. The price on the close of this candle was $13.90. The furthest out of the money strike was the 68.95 put option, and the buy price on the close of that candle was $11.65. Now remember, this is an FOMC day, FOMC interest rate decision day. So typically on FOMC interest rate decision days, the option prices are going to remain highly elevated as compared to what they would be normally because of the potential volatility of the FOMC decision, which happens at 2 p.m. Eastern New York time. So that's why even the furthest out of the money strike here, you can see, was that much money because of the elevated IV implied volatility for the FOMC day. Okay, so as I said, your stop losses are based on levels regardless of which one you're using the same levels for stop losses, whether it's a tight or the standard. Okay, so as you can see here, immediately after taking this bearish trade, it did start moving up. However, you can note here that we did also stay under the YDH level and the bull bear key price level on this entire opening candle. But then we started moving above it, and then we tried to get above the PMH level. We broke slightly above the PMH level, and then we hit our standard stop loss at 9:56 a.m. Now, if you look back here, there's a touch on this wick of the tight stop loss. Then there is a firm touch here of the body of the candle on the tight stop loss here. However, like as I said earlier, we don't have the prices for that. If you want to see what those would have been for the loss on these particular options, you can go back, and then you would want to either look at the low of this particular candle, the low of the option price, which would be the same as the high wick on this candle, would be the low of the option price on this particular candle on this touch when it did wick up there, or on this particular candle here. However, here it did wick up in this 9:56 a.m. candle. Now, this, as I said, is the low of the candle. So that means the worst case scenario. This candle actually closed at a better price. So if you got out on the close, the loss is less for each one of these. But we're looking at the worst case scenario. So we're going to assume that stopped out at the worst case scenario with the highest loss. So on here, the low price of the option on this candle, which it did touch the standard stop loss level, was $14. You paid $17.90, so that's a $390 loss per option. So for those of you who are not familiar with how options work, I'm sure that most people watching this video are. However, there's a few that do not understand. You take the price that you're paying for the option. In this case, $17.90. You multiply that times 100. That's the cost of one option. So the cost of one put option is $17.90 times 100. That's $1,790. If instead this price was $15 and we paid $15, then the price for one put option would have been $1,500. So if you bought two of these, one is $1,790, two would be 2 times $1,790, three, if you bought 3 puts, it'd be 3 times $1,790. If you bought 10, then it would be $17,900. So when you have a stop out here of $14, you're selling it and you're getting $1,400 per contract. So your loss after paying $17.90 is going to be $390 per option for this particular one. The 6,900 put was $10.80, so that's a loss of $310 per option. And the furthest out of the money, 68.95 put, the low of that option intracandle during intracandle was $9.58, so that's a loss of $207 per option. Now, as I mentioned at the beginning of the video, FOMC days are different than normal trading days. They're different for a couple of reasons. One is, like I said at the beginning of this video, that many traders just want to avoid them altogether and just skip those days. They go play golf, they go do something else, they go out on a boat, go to the gym, go see a movie, or whatever other activities that they're involved in, and they just skip FOMC days altogether because they can be very risky. First of all, with options, you're always dealing with elevated IV on FOMC days. So you're always going to be paying more for options on FOMC days as compared to a typical non-FOMC day. The second thing is that, especially after the 2 p.m. announcement and going into the 2:30 start of the press conference with Jerome Powell, you can see some very fast, and we saw today, some very fast moves. And for people that are not seasoned traders, that are sort of used to seeing these days and maybe trading these days, these types of days, they can be kind of overwhelming. And if you don't know what you're doing, you can lose quite a bit of money if the trade goes against you. So that is why some people prefer to skip them. However, there's a lot of traders that look forward to them and actually trade more on FOMC days because they like the increased volatility despite the elevated IV, and they prefer the elevated volatility for giving them heightened opportunities. But with those heightened opportunities and volatility also involves higher risk potentially. Okay, so we do have a loss here, but again, this is an FOMC day. FOMC interest rate day means the decision comes at 2 p.m. Eastern New York time, and then the press conference starts at 2:30. So the point I'm getting at here is we have a loss already. Since we have a loss already, then you're going to wait if you're still inclined to trade. And there are some people that use as part of their risk management, if their first trade is a loss, even if it's a non-FOMC day, they will stop trading for that session and just wait for the next session. There's other traders that have that rule by a dollar amount. If I lose X amount of money, I stop trading for the day. There's other traders that have it by amount of trades. Instead of the first trade's a loss, they may say if 2 trades are a loss or 3 trades are a loss, but they have some sort of rule, and that's up for every trader to decide for themselves in both directions. It can also work in the other direction. So if the first trade's a win, I may stop for the day. Or if the first or if I make X amount of trading profits in the session, then I'm going to stop trading for the day. There's other people that want to trade the entire session, period. And while that may not be the best strategy for most people, because it can involve, especially if you start losing several trades in a row, some people get into revenge trading, and then they sort of lose their cool, and that's the way that you can have losses that started out as minimal snowball into massive losses when you start losing your psychological control and you start basically going more into the gambling and revenge trading mode, as opposed to just looking at things mechanically and knowing in the back of your mind that there's always another trade session. However, there's not another trade session if you lose all of your money. So, people blow up their accounts. Sometimes most people that have blown up their accounts usually started out with a small loss that mushroomed into a much bigger loss by either doubling down on losing trades or by continuing to revenge trade on days where they just don't have it, or the market's not with them, or maybe they don't feel good, they shouldn't be trading because they feel ill, or what have you, and they shouldn't be trading at all. So you have to keep that in mind and keep in perspective that, create some rules for yourself. There's no universal rule that one size fits all. You just have to make some for your own account, your own risk profile, and how you would prefer to manage your risk. But it is good to have some kind of plan as opposed to just winging it. Okay, so on FOMC days, if the first trade is a loss, then I'm waiting until the 2 p.m. interest rate decision to involve myself in any more trades. First of all, most of the market is waiting for that interest rate decision as well. So the possibility, unless there was some sort of news that came out that was really major news before the FOMC interest rate decision at 2 p.m. And right now with the current president, he happens to be on a trip to Asia, so that possibly could have happened even today because he happens to be currently on a trip to Asia. So there actually could have been some good or bad major news that could have come out on this particular FOMC interest rate decision day. So all these things you have to be aware of. But generally speaking, everyone's waiting, and most times, for the interest rate decision at 2 p.m. Eastern New York time, and then after that the 2:30 press conference. So there's really no reason if the first trade is a loss, and if you didn't take that first 9:30 a.m. candle trade, then I would say wait until if you're trading at all on an FOMC day, then you may just want to wait until the 2 p.m. decision and then make a decision at that time if you're going to be entering into a trade or not for that session. Just keep in mind that at 2 p.m. there's only 2 hours left in the trading session for SPX. So you have to be very cognizant of that too, which we're going to go over with here in a second, that you don't want to be holding. If you get some quick strikes and quick profits, you probably want to be more inclined to not be waiting and continually adjusting them, because you are working against time at that point, because the meter starts running at 2 p.m. when that interest rate decision comes, and then the press conference at 2:30. So 2 p.m. to 4 p.m., there's only a 2-hour window. Now you can get incredible amounts of volatility in that 2-hour window, but you just have to be aware of the fact that at the end of the day, if you're on the wrong side of something, your options could, if there's 0 DTE, end up worthless. So if you're still holding them. And that's why we have that video that I talked about earlier, where you can also consider using 1 DTE options with this strategy, with this indicator as well. And you can take a look at that video, which goes over the pros and cons of those as well. But especially if you're using 0 DTE, you have to make sure that any trade you're opening up, say after 2 p.m., there's only 2 hours left. So you have to approach those in a little different fashion than ones that you're opening up at 9:30 or 9:45 or so in the morning. Okay, so here is the 2 p.m. candle here. This candle here. This is the interest rate decision candle here. As you can see, we went all the way up to the bull bear key price level. It just was short of the YDH level. So it went in between, and there's a very narrow range in between, because we're only talking about 64 cents difference between the YDH and the bull bear KPL. It went up in that zone right in between, that 60-cent zone. But it did go up, it backed off of it. As you can see here, earlier in the day, it did the same thing. Now we had this chop over here after this initial push that stopped us out. But ever since then, it's basically had many different times where it went up to the bull bear KPL or right in that zone that's in between the YDH and the bull bear KPL, and it just stopped and retraced. And it couldn't get over this time either on the 2 p.m. interest rate decision. So for me, this is now the bearish entry. You could have had bearish entries back here, and these would have worked out today, just like this one worked out. I'm just giving you my perspective on, for me, first trade is a loss, FOMC day. Why do I want to put myself in a position of perhaps having another loss when all the action is really, unless we get some major news from President Trump out of Asia, that happens before this interest rate decision, nothing really of any significance is going to happen until this interest rate decision. So here on this 2 p.m. candle, we pushed up, same as here, and backed off, and it closed below. So that's your bearish entry signal. So this is bear entry 2. Now on this, remember, this is the same level, bull bear KPL level, bearish entry. It's going to be the same stop losses as we used back here, standard and tight. Same option strike options at the money. First out of the money here, second out of the money here. Furthest one that you can consider is one level away. 69.10 at the money put option, buy on the candle close, $16.90. 6900 put on the candle close, $12.40. 68.95 put option, buy on the candle close, $10.72. As said, it's the same stop losses as before. In this case, neither stop loss came close to getting breached. And as you can see, there was really no attempt to breach either the YDH or the bull bear KPL after that. We did get this curl up here, but then we have this massive down candle here, followed by a few more massive down candles. Remember, these are 2-minute candles. So this is a credible amount of movement that's happening. We have 1, 2, 3, 4 candles. So down here is about 68.50. Up here is about 69.09 or so. So you've got basically a 60-point move in 8 minutes. Now, there's been other FOMC days where you had a move like this, maybe a little gyration, profit taking, and then it's gone down another 100 points. So sometimes on FOMC days you'll see that. Sometimes you'll see just a complete whipsaw where it goes down like here, goes back up to test where the breakdown occurred, and then it will just shoot up the other way after making a massive move down. So FOMC days can be very tricky. You have to be fast and you have to be prepared, especially like I was saying, that since these trades start at the 2 o'clock FOMC decision, if you decide to enter into any of them, there's only 2 hours left in the trading day. So you have to be cognizant of that in making your exit decisions. Okay, so here we have the 2:34 p.m. candle. So this candle, as you can see, slices through S1, the YDC level, and the mid S1, S2 level all in the same candle, and actually closed below the mid S1, S2 level. So in this one candle, we've gotten the required move for a scalp, which is a one level move, as well as the minimum required move for a regular trade, which that is a 1.50 level move. You may have seen our other videos. If you haven't, we talk about the difference between regular trades and scalps. So in scalping with this indicator, you were looking for a one level move in the direction that you're trading in order to close out your scalp. When you are scalping with this indicator, our view of scalps with the strategy is that when it meets the one level move, that you're closing out all of your contracts, whether you're trading 1, 2, 3, whether you had 5 put options, 10 put options, 50 put options. If your strategy is that you're just scalping, then when it hits the one level required minimum move for the scalp, then you're closing it out. You're not doing a stop loss adjustment. You are simply closing it out. Then you're flat, and then if you want to enter into another scalping trade after that, based on another level, then you're obviously free to do that because you have closed everything out. However, on a regular trade differs from a scalp is that it requires at least a minimum 1.5 level move in the favor of the trade. So what do we mean by the one level move for a scalp? What is a 1.00, a one level move? That is calculated from the level that you're taking the trade from in the direction that you're trading. What is one full level? This is a bearish trade taken from the bull bear KPL. Bearish trade, we're looking down. One full level down is S1. If instead we were scalping a bearish trade off of S1, then one level down is S2. If we were scalping a bearish trade from S2, then our target would be S3 for a scalp because that is one level down. If we were taking a bullish trade from the bull bear KPL level and we were scalping only, then we'd be looking for a one level move in the up direction, in which our exit would be R1. If we were scalping off R1 on a bullish move, then our exit would be R2. And as I said earlier on in this video, we do have a video about using the historical sessions feature that will show you the historical bull bear KPL and the historical main R and S levels in previous sessions that you can look at on different chart time frames, whether it's a 1-minute chart time frame up to a 30-minute chart time frame. But depending on what chart time frame you're looking at will determine how many sessions you can look back, because TradingView does have a historical look back limitation based on historical bars, which is determined by the particular plan you have with TradingView. Some TradingView plans have a 10,000 bar look back, some have a 20,000 bar look back, some have other ones that are different look back as far as historical bars. So as an example, if you're looking on a 1 minute chart, then there's 60 bars in 1 hour, and every day is 9:30 to 4. So you can figure how many bars are just in a 1 minute session, and if you have a 10,000 bar look back, then that's how many sessions you can look back. However, if you're looking on a 5 minute chart, there's 12 bars in an hour. There's so many hours from 9:30 to 4 each day, and then you can figure out, if you have a 10,000 bar historical limit on your plan, how many bars you can look back. But the point I'm getting at is not that, but that when you look back on the historical sessions, you can get an idea from those historical sessions when you're looking individually at each, when you're scrolling through each session, what other main R and S levels provide either scalping or regular trade opportunities to the upside or downside recently, and then maybe overall on an average. Recently meaning the last 2, 3, 4, 5, 6 sessions, or looking for an overall average, maybe you'd look at the last 20, 30, 40 sessions. And then you can get an idea of which other main R or S levels, because for example, if you're seeing that the SPX has a hard time ever going from R1 to R2 in a given recent price action, then you certainly would not want to, the odds would be against you if you're trying to enter into a bullish trade from R1 to R2, because it's shown recently that it's never traded from R1 to R2 in recent price action. That doesn't mean that it can't on a particular session, because every session is different. However, usually markets kind of go in waves, and so there may be several days or a week or two in a row where it pretty much is trading a certain way. And by looking back on the historical sessions, you can get an idea from that of other levels that may provide bullish or bearish opportunities by looking at how far it's moved. So if you're looking for a 1 full level move on a scalp, or at least a 1.5 level move in your favor on a regular trade. So again, a 1 level move for a scalp on a bearish play from the bull bear key price level, you're looking down, since that is a bearish play, in S1. So S1 is your exit. Now this all happened very fast, and you can have orders in Thinkorswim, and some brokers will allow you to place option orders and option stop losses, and also target exit orders based on the underlying hitting a price. Not every broker does that. Only some brokers do. So for example, Interactive Brokers does, Thinkorswim does. They offer both stop losses based on for options based on the price of the underlying, as a special feature that you can create a conditional order to that effect. And they also have those sorts of orders for take profits as well. So you may want to check out Thinkorswim. They also offer demo accounts. Interactive Brokers also offers demo accounts. So if you're not familiar with those particular platforms, you can practice on the demo account, so you can get the process down of doing those conditional orders, and just the process of doing the trades in general before you start putting real money on the line, and you don't want to be fumbling around not knowing what you're doing. So anyway, like I said before, it's always good to practice with a new indicator, especially if you're on a new platform. If you're on a platform you haven't used before, you especially have got to practice on a demo account to get used to the whole process of using that platform. So you don't want to put yourself in a position where you have real money in the line and you don't even know how to use the platform. So, um, so in any event, a 1.5 level move would be the midpoint down here. So this is the level we're trading. It's a bearish play. That's the level we're trading from. 1 level move scalp. 1.5 level minimum move for a regular trade. A regular trade differs from that aspect, the 1.5 level move requirement as a minimum. And the regular trade also gives you options as to what you're going to do for either exiting or an adjustment. So in a regular trade, you can adjust it at when it's met the minimum required move. So your options on that are either, your options on that are either on a regular trade, you can close out 100% of your contracts just like on a scalp, or you can adjust your stop loss to break even or break even plus 10 to 15% profit buffer initially if you don't want to sell any of your contracts, or perhaps if you just have one and don't want to sell it and want to see if you can make more money. And when you adjust it to break even, then at that time you are adjusting it by price. So if we adjusted our at the money to break even, we would be now, instead of having a level as our stop loss, now the price is our stop loss. So now 1790 is our new stop loss once it's hit the 1.5 level move on a regular trade. Or we would make it 1790 plus a 10 to 15% profit buffer. So that means 1790 plus 10% of 1790, or you could just round it off to $1.80, which would be 10% rounded off of the 1790. So you would add $1.80 to 1790, or you could just quickly do the math in your head and you could just say, okay, that's close to $2. I'll just make it $2 and then I'll make it $19.90. So in trading, it's also about being careful, being not making mistakes as far as typing mistakes. So you want to keep things simple. You don't need to go it down to the nth degree to figure out to the exact penny what 10% of 1790 is to the 10th degree. The main thing is just go ahead and make the adjustment. That's why it's a 10 to 15% range. So it's just easy to figure out in your head what something within that range would be as far as a quick adjustment, so you're not fumbling around trying to do that. And of course, every broker will allow you to adjust your stop loss based on the price of the option. It's just that there's only a few brokers, such as Thinkorswim or Interactive Brokers, and I think there's a few more, that allow you to have conditional orders of stop losses or take profits based on the price of the underlying. And we do have in the description of this video a video that you can watch, which we did not do, somebody else did on YouTube, and they did a very good job explaining how to do those conditional orders in Thinkorswim. You can look up on Reddit for Interactive Brokers how theirs works. I don't particularly like their system. I think it's very hard to use. Some people love it, but I find it to be very cumbersome. Other people swear by it though, so you may already use it, you may already love it, you may think it's the greatest thing ever, but if you want to check out Interactive Brokers, then there's probably YouTube videos on Interactive Brokers as far as placing conditional orders based on the conditional orders for options for either selling them or placing stop losses based on the price of the underlying. So you may just want to do a YouTube search for that, or do a Google search, or just ask Interactive Broker support directly for directions on that. Okay, so first we'll look at the scalp. So on this, like I said, this particular candle, because it was such a forceful candle, took out both the scalp minimum required move as well as the regular trade minimum required move all in this one candle. And we're just going to look at the close of the candle. The 69.10 put is 35.30. That's $1,840 profit per option. But remember, we had a 390 worst case scenario loss per option on that at the money. So in reality here, we only have a net of $1,450 per option at this point. The 6900 put is $28 in the close of this candle. That's a $1,560 profit per option. But remember, we had a $310 worst case scenario loss on that earlier on the stop out. So now we have a $1,250 net per profit per option. Keep in mind that these figures don't include any possible commissions you may be paying to your broker or any SPX clearing fees, etc. The 68.95 put, $24.90, that's $1,418 profit per option, a net after you factor in the loss on the stop out before of $1,211 an option. Now, if you've seen our other videos, we talk about a 2-level move is the ideal minimum move target for a regular trade, whereas the 1.5 level move is just the absolute minimum required target. Here on the next candle, we do get the 2 move, 2.0 level move. So it's 2 levels. S1 is 1 level, 1.5 levels. Now it's 2 levels at S2. So on this, you have the same decision to make. Close out. If you had here, I think one thing I forgot to mention earlier is this point. If you have multiple contracts, you also have another option where you can just simply close 70 to 90% of your multiple contracts. So you'd be closing them out for the full profit. And then adjust your stop loss to break even or break even plus the profit buffer of 10 to 15% added on top on any remaining runners. So for example, if you had 10 contracts you started out with, you sold 7, that's 70%. If you sold 8, that's 80%. If you sold 9, you'd be selling 9 of them, that would be 90%, and you'd have 1 left as a runner. If you had 5 contracts to begin with and you sold 4 of them, that would be 80%, and you'd have 1 contract left. If you had 3 contracts, you sold 2 of them, that's technically just under 70%. That would be like 66.67%. And then you would still only have 1 contract left. So on the contracts you would have left, if you took the scaling out route, you would adjust your stop loss to break even or break even plus 10 to 15% profit buffer left on any remaining runners. So when it hits the new target, okay, so here you also have the if you're doing a regular trade, you also could have just not sold any of them. That was the second option, and just adjusted your stop loss to break even. So on a regular trade, you could have either 100% closeout, just like with a scalp. Just close out, get your profit, now you're flat. B, adjust your stop loss on all of the contracts you're trading. Or C, if you have multiple contracts, then you could scale out and by closing 70 to 90% of them for the profit at this level, and then adjust your stop loss to remaining runners. So here, when it hits this level, you have the same options. So if you already sold here, then obviously you don't have any more options down here because you sold everything here on a regular trade if you took that route. But if you have any runners left, or if you just adjusted your stop loss, then here you have a decision to make again, the same decision. Do I close out all of them, or do I close out all the remaining runners, or do I adjust my stop loss? So here, the 69.10 at the money put, 40.45, $2,355 profit per option. The net is $1,965 an option after we factor in this loss from the stop out. The 6900 put is $33.40. That's $2,100 profit per option. That's a net of $1,790 an option after factoring in the loss from the stop out. The 6895 put is $28.70. That's $1,798 profit per option, or a net of $1,591 per option after the factoring in the stop out loss earlier. Now the move is not through yet, because in this very next candle, and just to mention before we go to that, as you can see here, this also touched YDL. So it touched the YDL level as well. So going back to what I was talking about earlier, about these also being important levels to also keep track of. But it did bounce off of YDL, but in the next candle, as you can see, it goes right back down, it slices right through YDL again, and it goes all the way down to just touch and barely close below the mid S2, S3 level. Then it finally bottoms out in the very next candle. But here you have the touch of the mid S2, S3 level, and it basically closes right on it. And that is the 238 candle. Hits YDL, slices through YDL, lands right on mid S2, S3 on the close. So that is a 2.5 level move. And if you have any contracts remaining when it does this, then you have the same decision to make. Again, do I close all of them out? Do I close out the remaining runners? Or do I adjust my stop loss again? Now, the 10 to 15% is if you're waiting to make if the 10 to 15% is a good gauge where you can either add on another 10 to 15% each time it goes down. Okay, you can add on another 10 to 15% of the amount that you started out with. That's one way of doing it. Another way of doing it is you could add more as it goes more and more in your favor, and the reason why is because sometimes you'll see it continue to move, but oftentimes after you get a 60, 80, 90 point move, you're going to get profit taking, and it's going to whipsaw around. Sometimes you'll just have a side step like this, and then it will resume, and then the selling will continue, and it could go down another 4 or 5 levels. So if you don't feel comfortable adjusting your stop losses, like for example, if you feel that's just too much managing for you, then just simply close out your trades, whether you want to close them out at the 1.5 level on a regular trade. Now this is if you're doing a regular trade. If you're doing a scalp, there is no adjustment. You're just one level, you're out. If you're on a regular trade, if you don't feel comfortable making multiple adjustments as it keeps moving down, maybe you only feel comfortable with the initial adjustment. And then on any remaining runners, or if you just did initial adjustment on all of them, then you're just either going to close out 100% when it hits level 2, or level 2.5, or level 3, or what have you. So it's good to know in advance as it hits a new level what your adjustment and stop loss is going to be as it hits each new level. So you have to have some idea what that's going to be. Either adding another 10%. You shouldn't do more than 10 to 15% on the initial adjustment at the 1.5 level, and the reason is that if you add on too much of a profit buffer, you're more often than not going to get just stopped out, and you might as well just have closed out everything, because then you're just kind of doing yourself a disservice. As it keeps moving in your favor, you can add more and more of a profit buffer, because as you can see here, it's exponentially growing here, and like down here on this one's all the way up to $53, whereas in the first one it was $35.30, and we're starting off from $17.90. So you want to have an idea of what your plan is going to be after the first, if you're going to stay in after on regular trades after the first 1.5 level move in your favor. Either you're just going to close them out. If you're going to stay in, what are your next moves going to be as far as any adjustments or just closing out when it and if it actually starts hitting the succeeding levels, because sometimes they happen this quickly. So you want to know in advance what you want to do. Okay, so as we see here, the 69.10 at the money put, 53.61 on this candle close here. It did go down further before reversing on the very next candle, but it did not reach the next level, the S3 level. So this is a full 2.5 level move. One level, 1.5, 2, 2.5. 53.61, that's $3,671 profit per option. That's a net of $3,281 per option after we factor in the previous stop out. 6,900 out of the money put, 3,200, that's 44.60. That's $3,220 profit per option, or a net of $2,910 per option after factoring in the earlier stop out. And the furthest out of the money put, 41.18, that's $3,046 profit per option, or a net of $2,839 per option. Now, as I mentioned earlier, remember these trades started at 2 p.m. and the market closes at 4 p.m. So there's only a 2-hour window here, so that's why it doesn't really matter if it's an FOMC day or if you were just taking a trade later on a regular day and you're initiating a trade that's at 2 p.m. or after 2 p.m. Just remember that there's not much time left in the day, and especially if you're trading 0 DTEs as opposed to 1 DTE, you don't want to be caught up in, well, it's gone down this many levels, maybe it'll go down another 5 levels, why don't I just hang around and do that? If you're going to be taking that route, then if you were trading multiple contracts and let's say you had 5 and you were just having 1 left and you already took out all your profit on the other 4, maybe, but you've got to keep in mind that there's only, the time is burning off the clock here, and with the strategy, you do not end the session with open positions because you're not going to hold any positions. So the whole thing is that you're going to be flat at the end of the day. Now with SPX options, if your options happen to be way in the money, you can technically just let them expire, and then they will pay you cash because they are cash settled. So that is something that you could do if you were so inclined and your options were way in the money. You could technically let them, if there were 0 DTE options, you could just let them, and they did expire at the end of today's session and they were 0 DTEs. You could have done that technically, and then you would just get the difference between the strike price and the closing price of XPX in your account. However, if you've been ever watching XPX for some time, you know that oftentimes in the last 5 or 10 minutes of a session or the last couple of minutes of a session, you can get some extreme moves in either direction, and you could think that you're in the money, and then all of a sudden you're not in the money anymore. So it's generally, even though technically you could hold them if there was 0 DTE, and technically, because of the style options they are, you would just get paid their cash settled, unlike SPY options. The settlement's different. You just want to have a process that you're not being put in that position where all of a sudden you could have a huge profit and then all of a sudden it turns against you in the last couple of minutes. And XPX does that a lot. So last 5-10 minutes of the session, you can get some pretty wild moves. That doesn't happen every day, but The point I'm just trying to make is that you don't want to be just falling in love with doing adjustments as you're running out of time, um, because of the fact that you just don't want to take the chance of ruining a bunch of profits because all of a sudden now you're running up against the end of the day. So that's just the main point I was trying to make. Alright, so now what we're going to do is we're just going to quickly look at the Thinkorswim data boxes so we can validate these prices on these different options, and then that will be the conclusion of this video. First, we're going to look at the 68.95. This is the furthest out of the money put option. So what we have here is, if you remember, the when things started getting going around 2:34 p.m., there were 3 candles in a row. So what I'm going to do is I'm going to show you this chart first, that just shows you basically the first entry of the stop out, the second entry, and where these candles are. But then I will show you a second chart, which is just a blow up of this section, so we can more easily see it, because it is kind of hard with it being 3 candles in a row here with these lines. Okay, so here's the first entry here of $12. Here's the stop out, and here I have the close underlined, but here is the low. So we're just assuming the worst case scenario on the stop out is that you're stopped out on the lowest price, $9.58. Here's the 2 p.m. Entry number 2, $10.72 on this furthest out of the money strike. And then here's the 234, 236, and 238 candles of when this was the scalp in the minimum required 1.5 level move trade on a regular trade, in which it went through all those levels in just one fell swoop. Here's where it hits the S2 level for the 2 level move on that candle. And then here is the final candle, the 238 candle, for the 2.5 level move, where it hit mid R2, R3. Next, we're going to look at the blow up. So this is the 2 p.m. candle here, 1072. This is the 2:34 p.m. candle. Now this is the one where it hits the S1 level. Then it also hits the mid S1, S2 level for both the minimum 1 level for the scalp, as well as the 1.5 level for the regular trade. Here's the 236 candle where it hits S2, 238 candle where it hits mid S2, S3. Now we'll take a look at the 6900s. Alright, here's the 6900 put. Here's the 930 entry number 1 on the close below the bull bear KPL, $13.90. Here's the stop out. Again, I've highlighted the close here, but we're just going to go with the lowest worst case scenario, $10.80. Here is the 2 p.m. FOMC candle here, which did close under the bull bear KPL, $12.40. And here are those other candles here. Now we'll take a look at the blow up of this section. Alright, the 2 p.m. FOMC candle here with the second put entry, 2:34 p.m. candle hitting the 1 level scalp and 1.5 level regular move. Minimum required regular move for regular trade. Here's where it hits S2 for the ideal 2 level move on regular trade. And then here's the 2:38 p.m. candle, which is right before it bottomed out on the next candle. And that hit mid R2, R3. Next, we'll take a look at the at the money 69.10. Alright, here's the at the money 69.10, $17.90 on the opening 9:30 a.m. 2-minute candle. These are also, just like all these charts, these are 2-minute option charts to go along with the 2 minutes we had on our other chart. 9:56 stopped out. Low worst case scenario on that candle, 14. So that's how you get your $390 loss. And then here is the second entry here, the 2 p.m. candle, and then here are those other three. And then here's the blow up, the 2 p.m. candle, $16.90, 2:34 p.m. candle, which was the S1 YDC and mid S1 S2 hit. Here is the 2:36 p.m. candle for the S2 hit, the 2:38 candle that hits mid S2 S3. Now we'll just quickly wrap it up by going back to the main chart. Okay, as mentioned in the preview of this video, you do have other links in the description of this video that go into other topics, so I invite you to take a look at those videos. Please also, if you like this video, please we appreciate it if you would like this video. That helps us with the YouTube algorithm. And if you would like to see more videos and be notified when we have new videos come out, whether they're trading session videos or videos on other topics concerning this indicator, please subscribe to our channel and you'll be notified when we release new videos. Also, if you're interested in purchasing this indicator, all of our indicators are sold on a one payment for lifetime access basis, which means that you do not pay a monthly subscription. You simply pay one payment at the beginning and then you have access for life. And then that also entitles you to get, since you have lifetime access, any future updates or enhanced versions that come out later. We are planning on coming out with a V3.0 version of this indicator very soon that will have some new enhancements and new features. So if you already have that, then if you already have the indicator, then you will at that time, then you will be able to get the newest version at no additional charge. Okay, and if you are interested in the indicator, in return for you taking your valuable time to watch this video today, you can request a discount promo code by sending us an email at daytradinggps@gmail.com and to request a discount promo code, and then we will send you a promo code for a substantial discount off of the regular price for this indicator. So again, thank you for taking the time to watch this video today, and we wish you much prosperity in all your future trading endeavors.